today we're starting with the first exam, okay? October, November 2016. The exam's out of 70 and it's 2 hours long. You're going to see two different sections, okay? Written and multiple choice. 35 multiple choice questions, and you've got some long questions as well. Okay, what I would do if I was you is I would split the time in half. So spend the first hour of the exam on multiple choice. Do as much as you can in the first hour. Once the hour is up, then move on to the long questions. Try complete them. Right, there will be some time left over, and then you can always come back to the multiple choice and answer the ones that you haven't done yet. Okay. All right, so section A is multiple choice. Let's shrink this a bit, and then we can put up the answers as well. Where are my answers? There's it. Okay. All right, let's do it like this so you can see both.
Okay. Oh, Anthony, I don't even have a calculator with me.
Okay, it's fine. I'll do the workings. You can do the theory.
Unless you want to give me 1 minute to just run to my car.
Okay, yeah, let's get the calculator rather, so then you can do the calculations, because things like NPV, IR, and things like that, you obviously need to do as practice. Okay, so I'll pause here. Go get the calculator, then we can start.
Okay.
Okay, section A.
Please share your screen.
Oh, sorry. I forgot to reshare it. Okay, section A, multiple choice. Questions and answers. Question and... let's write question 1. Right, so what is question 1 focusing on? Cash flow, right? Tammy?
Yeah. Yes, but I can't see the whole question, or is that the whole question?
That is the whole question.
Include all of the following components except... Oh, okay.
Okay, so it's testing what? Conventional cash flow. So do you remember what the difference is between non-conventional and conventional?
Well, the one has... doesn't have outflows, I think.
Which one?
I think it's non-conventional.
Non-conventional does have other outflows.
Okay.
Conventional doesn't. So which one does conventional not have?
The outflows.
Yes. Option number
2.
Yes. Easy, right?
Yes.
Okay. Book value, what is it?
Original. If I had to guess...
Don't guess, you should know.
I think 3.
Good. 100%. Okay, that's accounting, right?
Yes.
Cost minus accumulated depreciation, right? 3? What's the focus here?
A company has decided to replace an existing machine with a newer model. The old... Oh, geez, machine...
What happened?
No, man, everyone is just sending me messages and posting me, so everything, all these notifications are popping up. Sorry.
Oh, okay, this is something else. Oh, on your on your tablet.
Yes.
Okay, shame, man. Sure, I was just wondering what happened. Like, I mean, okay. Anyway, keep going.
Okay, company has decided to replace an existing machine, so that's replacement.
Okay,
And
so
renewal.
if it's a replacement, is the old relevant?
Yes.
Okay, so I need new minus old, right?
Yes.
Okay, what's the focus here? What do they want?
Let me just have a look. Okay, the old machine had an initial purchase price, so we're going to need that.
Well, that's the old.
Yeah, but we have to calculate the depreciation and that.
Well, what do they want you to find?
What will the tax effect of the replacement be? Oh gosh.
So you're looking at the sale, right? After-tax proceeds from the sale of the old asset.
Mm-hmm.
Okay, so what's the cost of the old asset?
240,000 plus the 30,000.
Okay, so that's 270.
Yes.
Okay, 270 is the historical cost.
Historic, yeah.
Okay, what else do I know about the asset?
And has 150,000 in accumulated depreciation, so we're going to subtract that.
Correct. It gives you what?
Let me just quickly do.
Gives you carrying value, right?
Yes, 120.
Okay, what did you sell the machine for?
60,000.
What is that representing? Proceeds.
Okay.
Is proceeds greater than carrying value?
Sorry?
Is proceeds greater than carrying value?
No.
Proceeds less than carrying value, so what do you have? Profit or loss?
A lot.
Loss on sale. So this will be a recoupment, not a recoupment, a scrapping allowance.
Okay.
Okay, so 60,000 is the loss. Times, what's the rate? 30%. 60 times 30% is 18,000. Is that a benefit or a loss?
It's a loss.
It's the tax effect.
What do you mean?
The tax effect is what?
Why can that be positive though?
It's a benefit because it's a scrapping allowance. You made a loss on the asset. So if you have a loss, what does that do to your profit? Increase or decrease the profit?
Decrease.
Yeah, so if you decrease the profit, do you pay more or less tax?
Oh, less tax.
Exactly. Okay, so benefit of 18,000.
Sure, I must be careful for that. Yeah.
Okay. Well, are you happy with this one, eh? Benefit of 18.
Yes.
Okay, next. What's happening here?
Expect that its battery charger will generate a net after-tax profit of 100,000 per year over the next 4 years. The charger was purchased for 20,000 and has a lifespan of 4 years and will be depreciated to a book value of 0 on a straight line basis. The firm is subject to a 3% tax rate. The firm's operating cash flow for the year is equal to... Okay, so it's cash flows again.
Yeah, OCF calculation, right?
Mm-hmm.
Okay, so you need the formula, right? Revenue minus expense and all of that stuff, right?
Yeah.
Okay, what year do they want here? for each year. Okay, so we're assuming that each year is the same here because they said after-tax profit is 100,000 per year, right? That's after-tax profit. So if it's after-tax profit, what does that mean? It's the net profit after tax, right?
Yeah.
Okay, which is profit after, profit for the year, basically. 100K a year, right? Yeah, 1 to 4. Okay, so what else do we know in the question?
Okay, it was purchased for 20,000. Hello?
Yeah, I'm listening. Keep reading.
Okay, so it was purchased for 20,000.
So does that help? Yes.
Don't
Why?
we?
You need to calculate what?
Your profit.
Depreciation.
No. Yeah.
What do you do with depreciation? Do you add it back or do you take it off?
You add it back.
Exactly. Okay, so how much is the depreciation?
Well, we have to calculate that.
So what is it?
20,000. Well, we don't know what's the rate.
You don't need a rate, you've got the number of years.
Okay, so the 20,000 divided by 4 years.
Yes. Gives you 5, right?
But isn't there usually a percentage?
Well, 4 years will be 25% a year.
Okay.
You agree?
Okay.
Okay. And then?
Then,
OCF. Do you like that one?
yes.
Easy, right?
Yes.
Okay, because they already gave you the after-tax profits.
Okay, so that 30% was just to screw us over.
Well, you wouldn't need it in this question because they said after tax. If they said before tax, then you'd have to take the tax off.
Okay.
Okay, so just read the question carefully.
Okay.
And then follow the steps that you already know from your notes.
Okay.
Got that?
Yes, just got put there option 4.
Why?
Don't you put the right option there?
Did I? Okay, yeah, I'll do that as well. Okay. I thought I just wrote the answers. Okay. Happy.
Yes.
5.
The portion of an asset's sale price that is above its book value but below its initial purchase price is called... Okay. Sure. I don't know. A capital gain.
Okay, well, let's write it down. Selling price, which is the proceeds. Right?
Yes.
Proceeds above the book value. Okay, so let's write down proceeds, let's write down book value, and let's write down initial cost price. Okay, so what did they say here? They said the portion of an asset sale price that is above its book value. Okay, so the selling price, which is the proceeds, 100, is above its book value. Book value is 50, okay, but below its initial purchase price. So below. So initial purchase price would have been, let's say, 120. Does that make sense?
No.
Okay, I'm just reading the
Yeah.
question. I'm putting some numbers down.
Okay, yeah, see, sorry.
Okay, so the portion of an asset sale price that is above its book value. Okay, so selling price is the proceeds, 100, is above its book value, which is 50, but below its initial purchase price, which is 120. Do you agree? Okay, so they're saying the portion of the asset sale price that is above its book value. Okay, so 100 minus 50 equals 50. Okay, that's the portion that is above the book value. Okay, above its book value but below its initial purchase price is called. Okay, so it's above the 50 but below the 120. Right, so if you bought an asset that cost you 120, if the current book value is 50, okay, how much depreciation did you have? You had 70, right?
Yes.
Okay, but now you're selling that asset for 100, and the asset's book value is 50. Okay, so 100 minus 50 gives you 50. Okay, so the capital gain is the difference between your proceeds and your book value, right?
Yes.
But remember, you've got cost here. So have you made a gain? No, you haven't.
No.
Because you've sold it for less than its
Cost.
Yes. Okay, so if I'm looking at the portion of the asset sale price that is above its book value but below its initial cost, capital gain, no. Capital loss, no. Book value, no. Recaptured depreciation, yes.
Yes. Okay.
Okay, so
I've
it's
never
almost like a
heard of that
recoupment.
word.
A recoupment or a scrapping allowance. Those are two different things that can arise. Okay, so a recoupment would be when you have a profit, okay, and then they're obviously going to take back their depreciation, okay, in the form of wear and tear. Right, so SARS will take that back. Okay, in this scenario, your proceeds were less than your cost price. Okay, because if I'm writing off the asset, I'm going to write off the asset for 120 Rand. I've only written off 70 Rand of the asset. But then I've sold the asset for less than its cost.
Yes.
Okay, so if you sold the asset for less than its cost, okay, obviously you need to, because remember you would have received a deduction over the life of the asset. Okay, so you would have claimed 70 over the life of the asset. The difference would have been something that you would have to recoup.
Okay.
Right, so I would go with recaptured depreciation here.
Okay.
Question 6. Focus here.
Okay. Purchase printing equipment.
Bless you.
Thank you. The installation amount and the investment requires an increase in working. Okay, so it's initial investment equals to.
Okay, so you need the INV.
Yes.
Okay, so INV requires a formula, right?
Yes, it's the cost plus the installation.
Is there an old asset? No.
No.
So it's just the change. So, okay, so as you said, INV, this is expansion. You prefer expansion then replacement because it's easier. Okay, so the cost would have been 120 plus 80. 8, not 88, gives you 128, right? Okay, and the investment requires an increase of 2,000 in the working capital. Okay, if you increase working capital, what is that going to do to cash flow?
Decrease.
It's going to decrease cash flow. So your initial investment is going to go up or down? It's going to go up because it's going to cost more.
Yes.
Net working capital, NWC. Okay, what was that? 2,000. Alright, so what's 128 plus 2?
130.
Yes.
Gee, it's actually not that bad, eh?
Yes. See.
Which of the following rules are essential to successful cash flow estimates and ultimately to successful capital budgeting? Okay, one is definitely not right. Only incremental cash flow are relevant to the... That's also not right. I think 3.
Okay, so they're asking you about the cash flow estimates. Okay, they want to know which of the following rules are essential to successful cash flow estimates. Okay, and budgeting, obviously. Right, so the initial investment is the only relevant cash flow. It's not. There are others. Only incremental cash flows are relevant to the accept or reject criteria. Well, incremental is looking at relevant costs. So do you only look at relevant costs?
No.
Well, you do. Relevant costs are what you would look at in terms of the decision making. Okay, they said total cash flows are relevant to capital analysis and the accept or reject decision. Do we look at totals or do we look at the difference between the new and the old?
New and the old?
Yes. Okay, so 2 would be the right answer. You don't look at total cash flows, you look at the incremental because you're making a decision.
Okay.
Got that?
Okay.
8?
In comparing the internal rates of return and net present value methods of evaluation. Oh my word.
What are you doing? Are you moving around again? There's a lot of background noise.
Sorry, y'all, this chair is very uncomfortable.
Oh, is it the chair? Okay. I thought you were moving furniture again to get a better signal.
No, it's fine, thanks. Okay, in comparing the internal rates of return and net present value methods of evaluation, the internal rate of return is superior, but financial managers prefer present value. No.
Definitely not. Okay, which one is superior?
The present value.
The NPV, yes. So, which option?
1.
No. Internal rate of return isn't superior.
Sorry, man, I'm being stupid. 2.
Yes, net present value is superior, but financial managers prefer the IRR because it's a percentage. Got that?
Yes.
Good. Payback period here. Oh, that's easy, hey?
I can't remember.
Oh, seriously? Payback period? Come, Tammy, think. Tammy, are you still there?
Yes, but I can't see is that the full question?
Yes.
Okay. The firm's evaluating a proposal which has the following cash flow. Oh, it's 3 years.
No, not 3.
4.
No, not 4. Payback period. How do you calculate payback period?
Oh, right. It's 1 1/4.
Well, 1 and something. We don't know if it's a quarter. How much do I pay back after 1 year?
20.
How much do I pay back after 2 years?
45.
That's too much, right? So I need 1 year, and how much do I want in the last year? 20 of the 25. What is 20 over 25?
Oh, that's 3/4.
Is it? No, it's
I
not.
actually don't know. Okay, let's just work it out. 20 divided by 25. Okay, it's 0.8.
Okay, so 1,8 years. Which option?
Well, is that 1,8 or is that 18?
Okay, yeah, that shouldn't be 18 years. I don't know why they didn't put a comma there. They should have. Okay, sometimes they leave out commas for whatever reason. I don't know why. Okay, sometimes you see them, sometimes you don't. Okay, it's odd. It's strange.
So we'll go with 2.
Yeah, you would go with 2 here.
Question 2. Okay.
Got that?
Yeah.
Okay. Next.
Occasionally there is ranking problem among NPV and IRR when selecting among mutually exclusive investments.
Isn't this your assignment question?
Oh, gee, I can't even remember, to be
Okay, it
honest.
looks so familiar.
Yeah, it does actually.
Okay, keep going.
This ranking problem only occurs when...
Yeah, we debated this, remember, with the left and the right.
Yes, I actually do remember it now.
Okay, awesome, good. So yeah, so with this question, you're either going with 3 or 4 here. I don't know which is correct because the ranking problem exists when you have NPV and IR, which is the WMCC. Okay, so I'm going to put a note here, C assignment 1 brackets video. We discussed it there. And we discussed it in detail. It took us like 10 minutes to discuss it. Remember that? We even drew diagrams and stuff.
Okay.
Okay. Right. It's in your assignment. We covered it earlier in question one of the questions in assignment 1.
Okay.
Okay, so it was 3 or 4.
Okay.
Okay, both are actually correct, to the right or the left. Okay, the ranking problem would occur on the right or the left.
Okay.
11.
One method of comparing mutually exclusive investments of different duration is to I would say 3.
Okay, what does mutually exclusive mean?
They not dependent.
So what does that mean? Can I accept more than one?
Yes.
No, that's independent.
Oh, sorry.
Okay, independent is when I can accept more than one project. Mutually exclusive means I can only accept
1.
one or the other.
Yeah.
Okay, so if they have different durations, what does that mean?
You have to compare, well, in order to choose one, you have to make them the same year.
Different useful lives, right?
Hmm.
Okay, so one method of comparing mutually exclusive investments of different duration is to consider only cash flows during the payback period. Well, the payback periods could be different. If they're mutually exclusive, you'd be looking at which is the better project in terms of generating more value.
Yeah.
Okay, would we apply different discount rates? No, you'd have to apply the same rate to both projects. So that one's out. Okay, would you evaluate them over an equal number of years? That's a possibility. Okay, and then number 4, consider only cash flows after the payback period. You won't look at cash flows after the payback period. Okay, so again, I think this was an assignment question. Right, the correct answer to this question should be annualized NPV. That's what you should be using.
Okay, but we can still go for 3.
But we don't have that option, yeah. So then if I was forced to choose an option, I would choose 3. Evaluate them over equal number of years. That could be that would probably be the better option. Okay, but the right answer is annualized NPV.
I think that's what they're trying to say by annualizing.
Possibly, but they're not doing a very good job by describing it that way.
Yeah.
Okay. Equal number of years? No, it's not equal number of years. It's for each project's number of years. It's an annualized amount. That's what you're doing.
Okay.
Keep going. Next one.
The present value of each cash flow of an investment is expected to total to 1.5. The profitability index is 1.25, I think. The initial investment is.
Do you have your notes with you?
Sorry?
Do you have your notes with you?
No.
You don't have your notes with you?
What notes?
Your notes.
The notes you sent me.
Yes. Do you have them with you?
Yes.
What is the equation for profitability index? Do you remember?
Nope.
Okay, we need to check it. I think it was net present value plus initial investment over initial investment. Let's check. Was that what it was? I think it was. Let me write that down. Number 2. There's number 2. Yes, there's it there. Yeah, it's right. Net present value plus initial investment over initial investment is correct. Okay, so that was right. Okay, so that's the formula. Let's write that down. PI equals bracket NPV plus INV close bracket divide by INV. That was right. Okay, let's work it out. What's the profitability index?
Just hold on, let me just write this down in Okay,
1.25. Right? Do you agree?
Okay, the net present.
No, not net present value. Here they said present value of the cash flows. So this is the PVCF. Okay, so if it's the PVCF, let me open up this file again. If it's the PVCF, it's this. Do you see that? Okay, so that's already adding the initial investment. Got that? Okay, so it's just the one over the other. Okay, so it'll be 1.5 million divided by INV. If you solve for INV, what do you get?
Well, you're going to times it, huh?
No. Divide.
Okay.
Option 2.
Okay.
Got that?
Let me just quickly write this down. 1.2 equals So you said the 1.5 divided by 1.25.
Yes, because the INV goes to the left, it becomes multiply, and then the 1.25 goes to the right, it becomes divide.
Okay, so it will be option 2.
Yes. Makes sense?
Yes.
Sure.
Yes.
Okay, next.
Sure. Okay, some firms use the payback period as a decision criterion or a supplement to sophisticated decision techniques because, wow, they use such fancy words. It explicitly considers the time value of money. No. It can be viewed as a measure of risk exposure. No.
No, it could possibly. Okay, could possibly. 2 is a possibility. 3?
Right, let me just read this again. Some firms use a payback period. Oh, okay. The determination of payback is an objectively determined. No.
Why do you say no? What does objective mean?
Calculated.
No, objective.
Yes.
What's the opposite of objective? Subjective. So if you're
Yeah.
subjective, what does that mean? There's bias. Do you agree?
Yeah.
Okay, so if there's bias or unbiased, okay, objective is unbiased, subjective is biased. Okay, so, and the determination of payback is an objectively determined criterion. Is it objectively determined?
Yes.
No, it's subjectively determined because it's subjective because you're looking at your preference for the project. Is the project longer or shorter than a specific time period? Okay, remember the payback period is always compared to what? Your minimum or maximum acceptable period, right?
Okay, but don't you first have to calculate if it's worth it to do it in that time frame?
But how do you know if it's worth it or not? You have to compare it to something that you create. You create the maximum acceptable. So you'll say, well, I don't want a project that's longer than 5 years. That's subjective. What's wrong with a project that's 6 years? Do you see what I mean? Okay, so 3 is out. 4?
It can take place of the net present value.
No, net present value is the best. Nothing can replace it. NPV is the best.
Okay.
Happy?
Yeah.
Okay, what's happening here?
Let me just quickly write that question 13 was option 2. Okay. We're doing question 14 now.
Yeah.
The following information, okay. Bafana Limited has undertaken a project with an initial investment of 5 million and the following cash inflows. The cost of capital is 0%. How the hell do they do that?
Don't ask me, I have no idea. Okay, how can you have 0% as cost of capital? That's a joke,
It was just given to them.
Pardon?
It was just given to them.
Exactly. Okay, so money was free, in other words.
Okay.
Okay, that's so weird. Okay, but anyway, I don't know why. I don't know. Sometimes there's errors. Sometimes these errors are really silly. So obviously, cost of capital can't be 0. That's impossible. There must be some sort of cost of capital. Okay, but we'll put in 0. I'm going to put 0 into my calculator. Okay, I'm calculating it. Minus 5 million. Okay, what's my first cash flow? 1.8. Okay, 1.8, 1.9, 1.7, 1.3. Okay, how many cash flows do I have? I've got 5, including the initial investment. That's good. Okay, so I've put all of that into my calculator. Escape, solve for NPV, and NPV comes out as 1.7 million. So is that there? Okay, yes it is. Okay, so the option is there, so you can get an answer based on that silly cost of capital amount. Okay, cost of capital is not going to be 0. In reality, cost of capital carries a cost. Okay, but even retained earnings, we know the theory says retained earnings need to have the same cost of capital as issuing new shares. Because if you retain all your profit, then you're not going to issue shares. But if you issue shares, then you paid out all your profit. Okay, that was the theory. Okay, so you can get an answer here. You get option 3, okay, when using 0% as your rate. Got that?
Okay.
Okay, so at least the right answer's there, so that's fine. If the right answer wasn't there, then that's problematic, so that's fine. IRR, okay, so now I need to work it out. Okay, so let me go to my calculator, escape, solve for IRR, and let's see what the calculator gives me. IRR equals, we had all the cash flows, 13.5696. 13.56967276%. Which option? Option 4.
Okay.
Okay, it's there, it's good. Okay. Got that?
Yes.
Next.
In the context of capital budgeting, risk refers to the degree of variability of the cash flows, degree of variability of the initial investment, chances that the net present value will be greater than 0, chances of the internal rate of return will exceed cost of capital.
Which one?
Sure.
Choose.
I think 2.
Okay, so the degree of variability of the initial return, not return, initial investment. Is the initial investment going to vary?
No, it's not.
That one's out. Choose again.
Okay, 1.
Yes. Good, got it. Easy, hey?
Yes.
Right, because you're not worried about the initial investment. You're worried about the inflows that you're expecting. Okay, no one knows what you're going to get from the project, but we'll have an idea. So the degree of variability of the inflows will affect the capital budgeting in terms of risk. Got that?
Yes.
Great. Next.
Monty Industries is considering investing in a project with an initial investment of 1 million. The project is expected to provide equal cash inflows over its 15-year useful life. The cost of capital is 10% based on the information the break-even annual cash flow for the project is.
What am I going to do to get the answer?
Well,
Time value of money.
Yes, and then we're going to have to do that
Do the
10%
what?
of the mil.
Yeah, what's the I? 10. What else?
The initial investment of 1 million.
Yeah, what else? N is 15.
Yes.
Solve for what?
Why payment?
Because it's the annual cash flow.
Okay.
And the answer is there. Except, oh, they rounded up. That's fine. Perfect. Yeah, see, brilliant answers. Right, 2016 was a good year for UNISA when it comes to FIN3701. Okay, there weren't mistakes in the assignment. There weren't mistakes in the past papers. Okay, besides a silly question in terms of zero cost of capital, the answer was still correct. It was still there.
Okay.
Yeah, so 2016 was a good year. If you are looking at past papers, I do recommend 2016's past papers because there aren't errors. Okay, and if there were, they're minor. I mean, like 0% cost of capital. That's not really an error. It is a rate. It's a weird rate to substitute into the calculator.
Okay.
Okay, make sense?
Yes.
Keep going. Doing good.
How many questions are there?
100.
Don't lie.
I don't know. All right, let's keep going.
A firm is considering two mutually exclusive projects. Project M has a life of 4 years, and an NPV of 2.855. Project N has a life of 6 and an NPV of 4540800. The firm has a cost of capital of 15%. Which of the following statements is correct?
Okay, so do you agree you're annualizing the NPVs? Do you agree?
I think so.
Okay, so M and N. Okay, M had how many lives? 4-year useful life. Right?
Yes.
What was M's NPV? 2855000, right?
Yes.
Okay, what is the I? 15%.
Yes.
Okay. N here is how much for N? 6. PV is how much?
4540800.
Yeah, 4540800. Yeah. And same interest rate. Okay, then to solve for PMT. Alright, so let's do this on Excel. Okay, PMT will be quicker. What's the rate? 0.15. My N is 4 here. My PV is 2855000. Close brackets, enter. Okay, there's the one answer. And the other answer is what? Let's check. This is going to be 6. And this is going to be, what is it? 4540800. Did I write it down right? 4540800, yes. Okay, there's the other one. Okay, which option's right? Oh, hold on a sec. What is 17's answer? I didn't put it in.
Oh gosh, I didn't put it in either.
Option 3.
Oh yes, sorry I did.
Okay, what is 18's answer?
Okay, the annualized net present value of project M is almost right.
Yeah, so I would go with 1 here. It's close.
Yeah.
Okay, so it's 1 million, yeah. Close enough if you round down.
Yeah.
Okay, I don't think none of the above is correct because M has that as the payment. Let me check it on the calculator as well. Okay, so I did it with Excel just to make sure there aren't any mistakes. 4 years, 15%, present value 2855000 equals. What do I get as the payment? Yeah, you get the same answer. It is right.
Okay.
Okay, you got 7 Rand there, which is a bit off, but that's the closest answer.
So you'd go with the 1 instead of 4?
I would go with 1 instead of 4.
Okay.
Okay. 19.
Okay. Which of the following statements is correct? Ooh. When calculating the weighted average cost of capital, the only specific source of capital that has to be adjusted for is tax. For tax is the cost of debt. That, I think, is true.
Yes, let's check the others.
The weighted average cost of capital can only be found by weighting the cost of each specific type of capital by its proportion in the firm's target capital structure. No.
It's not the target, it's the actual, what the actual capital structure is.
Okay. A breaking point is the level at which the cost of all the financing components rises. No.
A break point is the level at which the cost of all, okay, it's not all financing components, it's just the specific one that you're looking at.
Okay. The smaller the differences between IRR and the weighted average cost of capital, the larger the resulting net present value. Oh, I'm not sure about that one, but I'll go with 1.
Okay, it'll be smaller. Okay, if IRR is very similar to WACC, what does that mean? IRR is the return, WACC is the cost.
Okay.
Okay, so then you won't have a bigger NPV, you'll have a smaller one.
Okay.
Okay, so the smaller the difference, hold on. The smaller the differences between IRR and, okay, that's actually right, yeah. So if IRR was 10% and WACC was 10.5%, okay, that'll be a smaller difference between the two. The larger the resulting NPV, no, it won't. Okay, you'll get a larger NPV if there's a bigger difference, yeah, so 1 is correct.
Okay.
Got that?
Yes.
Okay, 20.
What is the dividend on an 8% preference share that currently sells for 45 and has a face value of 50 per share? Oh. Is it that Gordon thing?
Almost, yes. Why? Because you've got a pref share. If it's a pref share, does the pref share change its dividend?
No.
No. Okay, so the dividend is going to be constant. What is the dividend? That's what they're looking for. Okay, so PV equals R over, not R, PMT over R. Okay, so what is the dividend on an 8% pref share that currently sells for 45? Okay, and has a face value of 50 Rand per share. Okay, well that's actually pretty easy. Right, because they've given you 8% of the pref share. Okay, and the face value is 50. So 8% of 50 is what? It's actually a coupon question rather. 8% of 50 is...
I get 400. Well,
4 Rand, yeah. 8% times 50. Okay, 4 Rand. Okay, because remember those pref shares are quoted. Okay, so the current quoted amount is 8% of the pref share. Right, the current share price is 45, so that has decreased. And the face value, okay, the face value would have been the price at which you issued those pref shares at. Have the pref shares changed in value? Yes, they have. So it would actually be 8% on the 45. Okay, 0.08 times 45. 3 Rand 60. Okay, alright, this is 3 Rand 60 because it's the current share price. Okay, you'd get a dividend based on the current share price. Not what the price used to be. Okay, so 3.6. Okay, so that was an annuity formula. You didn't need it for this one because they gave you the percentage. Okay, it's option 2.
Okay.
Got that?
Yes. Oh, please tell me this was the last one.
Is it? Let's check. No.
No.
Still a few more.
Okay. The cost of each type of capital depends on the
Which one, Tammy?
all of the above.
Yes. Next.
Let me just write this down. EBIT is a descriptive label for operating profit, net profit before taxes, earnings per share, gross profit. 2.
Okay, I do think 2 as well, but let's just check the template in the textbook, because sometimes they use a slightly different layout than the IFRS. They should use something similar, but you never know. Okay, ratio analysis, chapter 3. We actually need chapter 2. Chapter 2 was the... Oh no, chapter 2 is the financial environment. Oh yeah, the textbook chapters are relabeled. Okay, so where is the... Okay, have a look at page 97, Tammy.
I'm supposed to get my book now.
Page 97.
Yes.
Where do you see EBIT?
At the bottom.
Yes, for what? Operating profit, net operating profit before tax, EPS, or gross profit?
Operating profit.
Yes, so it's actually number 1, not 2.
Oh, okay.
Okay, be careful. Okay, just need to confirm that with the textbook. Happy?
Okay, let me just write this down. So that was question 22. Yes. 1. Okay. Eskom debentures with a coupon rate of 8% and a par value of 1,000 were issued for, I don't know, is it 1,150?
Yeah.
The average tax rate is 40%. The debentures have a 10-year life. The approximate after-tax cost of debenture is...
Okay, first calculate the rates. What is the PMT? 8% of par. What is the par?
1,000.
$80.
Mm.
Were issued for 1,150 each.
Yes, so that is the future value.
No, present value.
Okay.
Future value is par.
Okay. Oh yeah. Anything sold for I.
Okay, let's check on the calculator. N is 10. I is what I'm solving for. PV negative 1,150. Payment 80. Future value 1,000. Solve for I. I get 5.96.
So we'll go for option 3.
No. No.
Why?
This is before tax.
Oh.
That's the answer.
3.6, okay.
Which option?
1.
Yes.
Okay.
So far, so good?
Yes.
24.
Okay, a firm has ordinary shares with a market price of 55 per share and an expected dividend of 281 per share at the end of the coming year. The dividends paid on the outstanding shares over the past 5 years are as follows.
Thoughts? Gordon growth, right? Okay, so work out the growth. Year 1, 2. Year 5, 2 Rand 60. 2. Okay, N would have been how many years? Year 1 to 5. So year 1 is 0. 2 will be 1, 3 will be 4 years. Solve for I. Okay, on the calculator, N is 4. I is what I'm looking for. PV minus 2. 2.62 FE. Solve for I. 6.98. 6.983751768. Okay, that's your interest rate for your growth. Okay, then apply Gordon growth equation formula. So I equals the div divided by net proceeds plus the growth. Okay, so I equals, what is the div? 281 divided by the net proceeds 55 plus what is the growth? We had it earlier. Okay, the growth is this. Okay, so on the calculator, what is this I equal to? Okay, so I equals 2.81 divided by 55 gives me that. Then add this. So I equals this times 100 plus that answer. Ooh, what happened? Oh, this is not a number. Okay, 12.09%. Which option?
3.
Yes. Okay, it's a bit off though. I'm not too sure why. It might be because of rounding. I don't use rounding. I put in all those decimals.
Okay.
Okay, so if I put in all the decimals, I get that answer. Okay, they've probably used rounding somewhere and then they get 3. Got that?
Okay.
Next.
A decrease in fixed financial costs will result in what in financial risk? A decrease.
Okay, well, if I'm decreasing the fixed costs, okay, fixed cost is what? Rent.
Yes.
Things that you have to pay, right? Whether you produce one good or no goods, or many goods. Okay, would you have more or less risk?
It won't make a change.
No, it will. You're right. Decrease. Okay, if you decrease your fixed costs, you'll have less financial risk because then you won't have as many costs. Fixed costs.
But didn't we say the last time with your fixed costs are ignored?
Okay, remember that was an assumption. That was an assumption. You're referring to the theory. Okay, I know what you're referring to. Let me put that up. Was it this? Yes, I think it was. Where's the assumption bit? Assumption bit. No, it wasn't there. Where is the assumptions? It was Miller and Modigliani. Remember that? Was it that? No. Okay, no, not this one. It must have been 5 then. 4.
Yeah, it was. I think when we were doing that rent and leasing, wasn't it?
No, it wasn't. Here's it. There's it. Okay, calculating cost of capital. See, this is an assumption. Okay, financial risk we will assume won't change if we affect the assets.
No, but I'm thinking of there was something.
Are you thinking about the formula?
No.
Okay, you can. If you want to think about the formula, that's fine. Then you'll have to use the leverage. Okay, so if you want to use the leverage, you can. Then you would use this equation here. Financial leverage. There, that formula.
No, I don't think it was that either.
Or this one. Where's the break-even point? The break-even point is here. This one. Fixed costs. If your fixed costs go down, you reduce your operating break-even point, which reduces the risk.
No, it isn't that.
Okay. Alright, I don't know what else you could be referring to.
Yeah, I remember you saying that something to do with your fixed costs. It's not going to be I'm thinking of when a cost has already been incurred and it's not going to be relevant to...
That's a sunk cost.
Yes, that's exactly what I'm thinking about.
Okay, yeah, that's chapter 1. That's relevant costs. Sunk costs aren't relevant.
Okay.
Okay, so you were right. Your initial answer was correct. Don't doubt.
No, that was 25. Was 2.
What did I write? 20. Oh, sorry. 25 was 2. That's fine. Okay, why did I do that? Okay, that's strange. Okay. Oh, we were looking at the next question. Then you and then you stopped me to ask a question. Okay, that's fine. Okay, so 25 is 2, right?
Okay. Oh, is there seriously more questions?
Yes.
Is there 40 questions?
Let's see.
Oh my word.
Okay, there's 35.
Shissy, that's very long, eh?
Yes, quite a bit. Okay, but we're not going to do the long questions today. I just want to finish the multiple choice.
Okay. But I'm just concerned in finishing this in the exam.
Okay, yeah, in the exam. Well, remember, in the exam, you need to try work a bit quicker. So obviously, we're working slowly because I'm testing you. I'm asking you questions. We're discussing it. It's taking a bit longer.
Okay. Okay. Given the cost of ordinary shares is 18%, expected dividends are R1.50 per share, and the price of the share is, I don't know if that's R12.50.
It is.
What is the annual growth rate of dividends?
Gordon growth, right?
Yeah.
Okay, so they want to know what the growth is, what the G is. You've got the price. R12.50 equals the dividend, R1.50. Okay, R1.50 is the expected dividend. Divide that by open brackets R minus G. R is 0.18 less G. Do you see that?
Yes.
Okay, then what do? Solve for G. Okay, so take that stuff to the right. It becomes multiply.
To the left, you mean?
The left, yeah. Okay, from the right to the left. So then I've got, what's 12.5 times 0.18?
I don't know.
Work it out.
12.5 times 0.18 is 2.25.
Okay, great. So that is right. Okay, equals 1.5. Alright, and then I need to solve for G. Okay, quickly solve for G there. What do you get?
So I'm going to say 1.50 minus 2.25. Am I right?
Divide by what?
Yeah, then divide by 2.25.
No. Ooh. What happened? Do I need to put more another step? Tammy?
Yes?
What did you get?
I'm asking you a question.
Okay, what was the question?
So to solve for G, I must say 1.50 minus 2.25 divided by 2.25.
Ooh, no. It's this. It's 2.25 minus 1.15. Other way around.
Why?
Okay, you're taking things to the left and the right.
Why couldn't I just take the right to the
Okay, that's fine. Then what do you get? Do you get the same
of
answer?
the left to the right?
Okay, then do I get the same answer? What do you get?
I don't know, I must work it out.
Okay, go work it out quickly.
So I'm first going to say 2.25 minus 1.5. 2.25.
Divide by?
How the hell does this work?
Divide by 12.5.
Yes, divide by 12.5. 0.18.
No, 1.06. 0.6. Okay, 2.25 minus 1.15 gives me 0.75. That's what I got.
2.25 minus 1.5. Oh, now I get 0.7.
Yes.
Divide by 12.5. 0.06. Okay.
Sure?
Yes.
Happy?
Yes.
Theory?
I just want to say, so that was option 3.
Yes.
Okay, question 27. Which of the following statements is correct? Interest payable.
Incorrect.
Okay,
You said correct.
sorry. The interest payable on long-term debt reduces the tax that a company should pay. Yes. The cost of capital can be defined as the minimum rate of return that a firm should earn on its investment. Yes. The cost of preference shares is a fixed financing cost and can therefore be deducted for tax purposes. No. I don't think that's right.
Okay, what's about the last one? Read the last one.
The cost of retained earnings is equal to the required rate of return on owner's capital. Oh no, I don't know.
Okay, it's between 3 and 4. Right, so cost of retained earnings. Okay, remember the theory said we need to give a cost to retained earnings because we can't use 0. Right, is it the same as the required return on the owner's capital? Yes. Okay, the cost of preference shares is a fixed financing cost and can therefore be deducted for tax purposes. Okay, a preference share dividend isn't something that's tax deductible because it's a dividend. Okay, so that one's wrong.
Okay. A firm has a capital structure consisting of 400,000 debt with an annual interest rate of 12% and 50,000 ordinary shares. The firm's tax rate is 40% on ordinary income. If EBIT is expected to be 200,000, the firm's earnings per share will be.
Okay, so it's a counting question, hey?
Yes.
Alright, so now we need to less the interest, less the tax to get the net profit after tax, right?
Yes.
Okay, so how much is the interest?
12%
Of what?
of the 400.
Yes. Okay, so how much interest do I pay? 48. EBIT less interest gives me that. What's the tax rate here? 40%.
Yes.
Okay, net profit after tax, EBT minus tax gives me that. That's my net profit after tax. Okay, what did they say? You've got 50,000 shares, so EPS. $1.82.
Okay.
Got that?
Yes.
Okay, option 1. $29. EBIT at 200,000, interest expense of 50, pref share of 400, and a tax rate of 40. The firm's degree of financial leverage at the above level of EBIT. I need the formula. Go to the notes, chapter 5. Degree of financial leverage is this equation. No, wrong one. This equation. Yes. There's it. Okay, so DFL. Right, what is my EBIT?
We have to work it out.
No, it's given in the question.
Oh, 200.
Yes, divide by, open brackets, 200,000 less. How much is the interest?
40.
50.
Oh, okay.
Less the div. Less the div of 4,000. 4,000 times brackets 1 divide by open brackets 1 minus 0.40. Close that bracket, close that bracket, close that bracket, close that bracket, equals. Answer there. Ooh, hold on a sec. I did something wrong. What did I do wrong?
There's too many brackets.
Oh, there's 1, 2 little zeros. Okay, there's 20,000 there. Do you see that? Should have been 200,000. Okay, put an extra 0. That's the answer. Yes.
Okay.
Option 2. Easy, hey?
Phew, I guess so if I know this formula.
Yes, that's all it is. Just needed the equation.
Okay.
30. Last 5. Come, Tammy. You can do it.
Till I'm tired now.
You can rest afterwards. We're almost there.
Okay, according to the residual theory of dividends, if the firm's equity need exceeds the amount of retained earnings, the firm would...
Okay, so residual theory of dividends means we pay out dividends only after we've accepted all the projects. So if the firm's equity need exceeds the amount of retained earnings, will we have retained earnings?
No.
No. So will there be a payout?
No.
No. Okay, so the firm needs all its equity. Okay, so there aren't going to be any earnings to be paid out.
Okay.
Okay, because they said here, if the firm's equity need exceeds the amount of retained earnings. Okay, they're actually going to have to raise additional capital. But here they're not talking about additional capital. Here they're talking about dividends.
Okay.
So we won't pay out a dividend. Okay, here's theory. Miller and Modigliani.
Okay. Suggested that the value of the firm is not affected by the firm's dividend policy due to relevance of dividends, the clientele effect, information content, the optimal capital structure.
Okay, we just need to check the clientele effect. That's theory that comes up in the glossary. I forget what the clientele effect is off our hearts. I'm just trying to find the page. Okay, clientele effect is on page, where is it? Clientele, there, clientele effect, page 825. The argument that a firm attracts shareholders whose preference for the payment and stability of dividends correspond with the payment pattern and stability of the firm. That's incorrect. Okay. Miller and Modigliani, let me give you a page reference for that so you can look at the theory. Miller and Modigliani. Okay, Miller, no, that's brewing company. Okay, they don't have a reference for it. Okay, Modigliani, let's see if they have a reference for that. M-O. Okay, Modigliani, 518, 558. 518, 558. 518, okay, and 558. All right, so here on page 558, they're talking about the leverage and capital structure. Okay, here they say it's not affected by the says the value of the firm is not affected by the firm's dividend policy due to. Okay, dividend policy is probably 558. Let's check 558. Yes, 558 is there. Okay. Dividend theory policy, yes. Okay, so page 558 is your reference here. Okay, this is very specific theory from page 558. Miller and Modigliani. Okay, they talk about the dividends irrelevance theory. Okay, so such a view is consistent with the dividend irrelevance theory put forth by Miller and Modigliani. They argue that the firm's value is determined solely by the earning power and risk of its assets, and that the manner in which it splits its earning streams between dividends and internally retained funds does not affect value. There's the answer. Okay, so Miller and Modigliani suggest that the value of the firm is not affected by the firm's dividend policy due to, it would be the residual theory of dividends. Okay, relevance of dividends? No, it wouldn't be relevance of dividends. It would be the residual theory of dividends. Okay, residual theory of dividends is not there. Okay, clientele effect? No. Information content? No. Optimal capital structure, that might be it. Let's check here. Is there anything else in the paragraph? Let's see. Yeah, it's unaffected by the distribution of dividends. So relevance of dividends, relevance means dividends are relevant. This is the dividend irrelevance theory. Miller and Modigliani theory that in a perfect world, the firm's value is determined solely from the earning power and risk of its assets, and that the manner in which it splits its earning stream between dividends and internally retained reinvestment funds does not affect its value. Okay, see, I think there might be a mistake here. They should have said not the relevance of dividends, the irrelevance of dividends. Okay, it's the irrelevance theory. That's the problem with the question. Okay, so there might have been a slight errata here in terms of mistake. Okay, if we go on, what else does it say here? They say that the client self-effective is different types of different. I see tax exempt. Here they're looking at Miller suggests that the value of the firm. See, this is looking at firm value. Yeah, firm value is affected by the payout. So whether we pay out or not, it doesn't affect the company's policy. Okay, even in the last paragraph, do you have your textbook open there?
No.
Okay, if you look at the last paragraph on page 559, they say, in summary, Miller and Modigliani and other proponents of dividend irrelevance argue that, all else being equal, an investor's required return, and therefore the value of the firm, is unaffected by dividend policy. In other words, there is no, inverted commas, optimal dividend policy for a particular firm. Okay, so there is no optimal dividend policy for a particular firm. Okay, so suggest the value of the firm is not affected by the firm's dividend policy due to... Okay, I'm going to write a note here. It should be the irrelevance of dividends theory. Okay, it should be the irrelevance of dividends theory. Okay, and that's in the textbook. Okay, so I do think they're missing a letter here. It should be IR, the irrelevance of dividends. That's what they should have written here.
Okay.
Okay, none of the others are applicable. Okay, it should be irrelevance of dividends. Okay, so errata for this one. Okay, so one bit of errata there. Okay, just read, if you read the theory on page 558 to 559, it motivates that. Okay. Alright, 32.
I just want to write just. So, but if I have to choose, we choose option 1.
If you were forced to choose, then option 1, yes. Okay, but remember, it's not relevance of dividends. It's the irrelevance of dividends.
Yeah. Okay. Okay. A firm has current after-tax earnings of 1 million and declared a cash dividend of 400,000. The firm's dividend payout ratio is...
Ooh, that's easy, eh?
So you just take the divided.
Yes. Happy?
Yes.
Next.
Question 2 is option 4. And 33. The factors involved in setting a dividend policy includes all of the following except.
Oh, this is easy.
Restrictive covenants in a bond indenture, growth prospects, the legal prohibition and paying dividends which exceed current earnings.
Which one?
I don't know.
Really? What are we focusing on here? Dividend policy. Dividends are paid on what? Tammy? Dividends are paid on what?
Okay, if they exceed current earnings.
Dividends are paid on what? Shares.
Yes.
What is number 1 talking about?
Bond. Okay. Okay.
Do you agree?
Yes.
Okay. 34.
The overriding goal of mergers is to increase cash flows. No. Maximize shareholder wealth as reflected in the acquirer's share price. No.
Yes, that is it.
Why?
Because if you're acquiring an asset, you're increasing the company's value. Okay, InBev, SAP InBev, the merger. Okay, the merger is looking at generating wealth for the acquirer, because the acquirer will increase its share price because they're going to be receiving a bigger, or let's say if they're buying a part of the business, so it's getting bigger. Okay, so it's between 2 and 3. Okay, maximize shareholder wealth as reflected by the share price of the target firm. The target firm is the firm that's being bought. Okay, so when I'm buying companies, I'm buying with the goal of increasing the company's share price. Got that?
Okay.
Okay, and then the last one, finally, hey?
Okay, so 34 is 2. Okay. Mergers are undertaken for either strategic or financial reasons. Which of the following statements aptly describe a strategic merger? The acquirer wishes to sell off certain unproductive or non-compatible assets to improve cash flow. No. The acquirer seeks to achieve various economies of scale. Yes. The acquirer seeks to restructure the company with a view to unlock hidden value. No.
Ooh. Financial. Is this financial? Yes. Is this financial? Yes. Is this financial? No, this is strategic. Tammy? Got that?
Yes, but I can only choose one.
Yes. So, option 3. Which of the following describes a strategic merger? The acquirer seeks to restructure the company with a view to unlock hidden value.
Okay.
Okay, it's financial, strategic.
Okay.
Happy with 3.
Okay.
Okay. And that's the end of the multiple choice.
Okay.
How much marks did that carry? Let's check. How
70.
much marks does section A cover?
35.
Okay, so you got 50% of the paper already. Yeah, that's half the paper. Okay, remember the paper's out of 70. Okay, so multiple choice counts 50%. Okay, so you've done half the paper. Happy?
So it's 1 mark for each question?
No, it's slightly more than 1 mark for each question. 35, so let's see. 35, 50 divided by 35 is, it's 1.4% a question. Okay.
Okay.
Happy?
Yeah.